founders today are much more switched on, much better educated about the way business works than they were 20 or 30 years ago. So I think that's one big change that I've seen. The second change, of course, is that there is no change, and what I mean by that is that the cycle will always remain. There are going to be times when it's very easy to raise money. There's a glut of capital. It's a seller's market, and when I say seller, I mean the person who owns the company selling shares to the investors. And therefore, when it is a seller's market, then the investors have to pay more to get into the good deals. It's easy to raise money.
So, Martin, firstly, thank you so much for taking out your time from your busy schedule and joining this podcast with me to share your extensive experience in the startup ecosystem and your journey as an investor in big VC fund as a director. I'm sure it will be really insightful conversation, and I will get to know, and all of our audience will get to know a different perspective altogether in the startup ecosystem. So welcome to our podcast, and thank you so much for agreeing on being the guest on this podcast.
Not at all. Thank you very much for asking me. I'm a great admirer of everything that O2H has done. As you know, I've known Prashant and Sunil a very long time. And it's my very great pleasure to have met you as well and to get to know more about the organization. And I would be delighted to talk about anything which is relevant about early stage technology investing from my experience in Cambridge.
Awesome. The pleasure is all mine, Martin, and thanks again. All right, so let's start with, although when I was in Cambridge, we met in person and I got to learn a lot of things from you and about you. But just for our audience, if you can give us a small context about your background and your journey, that would be really helpful.
So I guess in some ways I'm a pretty unlikely technology investor because I read history at university for my first degree, and secondly, I was a soldier, a regular army officer for 10 years. But after I left the army in the mid-1980s, I went to business school at Cranfield. And while it was there, I came across the recruiting activity of 3i. And 3i was the main venture capital and private equity investor in the UK at the time. And they decided that my skill set, when I was offered a job by them, was best suited to the Cambridge office of 3i. About which I was delighted because I've always been a technophile, even if I don't have a formal technical or science-based education at university level. So I was sent by 3i to join their office in Cambridge in 1986, having finished my MBA at Cranfield. And within 3 months, Richard Summers, who ran the office there, asked me to co-manage the startup unit. So that was my launch into investing in early stage technology businesses. And at the time, it was a mix of life sciences, some diagnostics and some therapeutics, generic therapeutics, and physical devices, IT related, and some software businesses as well. And I did that for a couple of years before I thought what I wanted to be was an entrepreneur. So I went out and started a business about which we will say very little, other than that was in toy manufacturing, quite hard. And in order to keep bread on the table while I was trying to get this toy manufacturing business going, I also gave corporate finance advice to early stage technology businesses. And it was in the course of doing that HSBC came across Egan and Talbot, as ET Capital was then called, my business, and said, we're looking for a fund manager for a regional early stage venture fund. Would you be interested in doing that role? Would Egan and Talbot be interested in that role? And we said yes. And so, to cut a very long story short, after some hard work and some rather frustrating fundraising, in 1993, we opened what had then become the HSBC Enterprise Fund for East Anglia and the home counties, investing in early stage technology businesses in the greater southeast of England, north of the Thames. and also in East Anglia around Cambridge. And that business, that fund was the first fund we managed. And since then, we've managed another fund for HSBC, a specialist technology fund called QTP. And we also raised money from the European Investment Fund. We then took on a secondary called Cambridge Research and Innovation Limited. And we've also then subsequently run 4 more funds, 2 of which are low carbon. No, sorry, 5 more funds, 2 of which are low carbon, and 2 of which are focused on businesses coming out of the Carbon 13 accelerator here in Cambridge. And then a rather more unusual fund, which is a joint venture with some Chinese venture capitalists, which is looking at technology businesses created in the UK, which might scale up in China. So since 1993, ET Capitalist manages, as I say, 8 funds, and we're working on our 9th fund now. 8 funds? No, 7 funds, and we're working on our 8th fund. Sorry, let me be absolutely accurate.
That's great. And I think it worth mentioning that your overall just finance fund manager experience is more than overall my age.
Oh dear. Yes, I mean, I have, and it's been an interesting journey to be an investor over that period, because at the beginning, when I started investing for 3i in the late 1980s, Cambridge was a remarkable time because we had 2 full stack computer manufacturers, PC manufacturers, or in those days called microcomputer manufacturers. We had Acorn, founded by Herman Hauser and Christopher Curry, which ultimately begat ARM, as you know, the global semiconductor intellectual property giant. And the other firm in the town was Sinclair Research, which was Clive Sinclair's highly innovative, if rather maverick, computer company, which produced a series of tablet and portable computers, which were ultra low cost, very unusual at the time. So it was very interesting to be in a city which had everybody from people designing semiconductors right down to people writing manuals for consumers to use when they bought microcomputers and wanted to take them home and learn how to use them. So very sort of broad skill set developed in the town during the 1980s. And I think that stood Cambridge in very good stead. So it's been interesting for me to watch that journey since that time.
I'm sure, and I'm sure during your this tenure, you might have seen very tiny startups, turning into big giants. As you mentioned, the ARM is one of them. So yeah, and also if you had to explain, let's say, this fund manager or fund management role, so to say, to a 12-year boy in a layman language, how would you simplify it?
Well, I don't know whether you know, but about 10 miles east of Cambridge is Newmarket. And Newmarket is a famous global centre of horse racing. And 2 of the great flat races, classic flat races, the 1,000 Guineas and the 2,000 Guineas, are raced at Newmarket in July each year. So everybody around here knows quite a bit about racing. So I like to use racing as a metaphor for what a fund manager does. You know, it's a good way to enable the, as you say, the man or woman in the street to understand what we're about. And I like to say that we are like a racehorse owner. And so what we do is we have to select a good horse. Well, that's the business idea, the proposition. We have to then identify a trainer to train the horse and a jockey to ride the horse, although the trainer does that. So the trainer is the chief executive and the key management team member, for want of a better description. And the jockey is the rest of the management team in this case. I mean, that's the metaphor breaks down a little bit. So what we're about doing is identifying really good horse flesh, really good investment propositions, and then somebody really to drive the value out of that proposition. In other words, in the same way that a trainer takes a great horse and makes it really perform well, and then with the jockey riding on the day, maybe you can see the race as being the marketplace. So you have to choose the right marketplace, the right race, to take your horse out and win. I think that's a very good sense of what we do. So once we've invested in a business, we take a very strong interest in the direction it's taking, the success or failure, and try to help the management team to identify better opportunities for the technology or the product, help them with their go-to-market strategy, help them, and most importantly, of course, with their corporate finance strategy, ensuring the business is well funded. But let's not forget that an investor invests for one reason and one reason only, which is capital gains. Which is to sell the business for a profit, either by floating it on the stock market or by selling it to another business. And so one of the critical roles of the venture investor is to try and help the management team steer the business to a successful realization. So that's what we do.
Fantastic analogy that I have listened to in terms of investment by far. So thank you so much for that. Going back to your transition from your involvement into the armed forces and then as an investor. So how did you join this investment domain, so to say? How did you try to go back?
Sure. No. Well, I was always interested in business because I come from a family business background. My great-grandfather founded a business in Birmingham in the Midlands of the UK, an industrial city, which was originally in recycling non-ferrous metals, but they developed a precision engineering division in London at the end of the 19th century. About 1895, they opened their workshops in London, and they started making scientific instruments of various kinds using precision engineering techniques. And they were very lucky because down the road there was a retailer called Butchers of High Holborn, and they sold cameras and projectors and all sorts of equipment to do with photography and with cinematography. And so Robert Rigby, after about 5 years, started to specialize in making equipment for the film industry. So that specialization in technology was part and parcel of my life as a boy. And we developed this business over 3 generations and eventually sold it in the 1980s. So I always knew that I had an interest in technology and an interest in business. So when I came to leave the army, I went to business school at Cranfield, because that's a very army way of doing things. Make sure that you're properly trained before you start something. And so that was really the way in which I changed from being a soldier to being an investor. And I was just lucky that when I was at Cranfield, 3i came on what's called the recruiting circus, and I pitched to them and they gave me a job. So I was very lucky.
Fantastic. Yeah, I was very curious regarding your switch. Now it makes sense for me why you were so interested in the finance and business domain, so to say. All right. Now coming to your role as a fund manager or advisor, what changes do you see, or let's say, what changes do you see in the thought process of these early stage founders, and what changes do you see in terms of the investment patterns, so to say?
Well, I think those are really good questions, and I think there has been a lot of change. I mean, the first thing I think is that in every technology originating economy, and obviously I would include the UK, I would include India, I'd include China, the US, Western Europe, Japan, places like that. University students are much more exposed to entrepreneurship electives and entrepreneurship training, and many people at university in India and in the UK will have joined some investment club or some startup club, or will have taken some really sort of detailed interest in the entrepreneurial journey. So I think the first thing to say is that founders today are much more switched on, much better educated about the way business works than they were 20 or 30 years ago. So I think that's one big change that I've seen. The second change, of course, is that is that there is no change, and what I mean by that is that the cycle will always remain. There are going to be times when it's very easy to raise money. There's a glut of capital. It's a seller's market, and when I say seller, I mean the person who owns the company selling shares to the investors. And therefore, when it is a seller's market, then the investors have to pay more to get into the good deals. It's easy to raise money. Now, as you know, in the last 2 years, we've been going from a seller's market into a buyer's market because capital has become more constricted. It's much harder to raise A, B, C, and subsequent rounds. And entrepreneurs have to be much, much better at articulating and demonstrating the competitive advantage in their businesses. Now, again, one of the good things about the fact that entrepreneurs, particularly young technology entrepreneurs who come out of good universities, they are more switched on about how to present their ideas more cogently and more effectively. They are better equipped to engage with investors than they were 10, 20, or 30 years ago. So I'm optimistic that the process will continue to work and continue to work well. I'm afraid, you do need tough times because tough times winnows out the weak businesses and concentrates resources on the strong. And in the long term, that's good for all of us. So, yeah, I think that's the big change I've been seeing, a general improvement in the quality of early stage investment. Of course, a huge amount more money available in the last 10 or 15 years, but now going into a period where it's going to be much harder to raise money. And therefore, it's really going to focus on those entrepreneur skills that I mentioned earlier.
Mm-hmm. Makes sense. As an investor, what are those aspects that you would look for in any startup to invest? Let's say, and do you have sort of a checklist, so to say, that a startup should have XYZ things, and then only I'll be investing into that?
I think actually, as I've been doing this a very long time, and it reduces down to one critical thing, which is the quality of the management team. A great management team, I'm afraid, this is absolutely, perennial, is a great management team will make something even of a relatively indifferent business or market opportunity. Therefore, while it's great to identify some groundbreaking technology which has the capacity to change the world or change an industry, you never know whether an analog technique or an analog technology is going to come along in the future and bypass that product or technology, even if it is protected by a huge array of patents. And so a management team has to execute. And I think one of the things that's good about the present climate is that investors really are expecting management teams to demonstrate that they're executing. In other words, they can get the product to market and sell the product and generate revenue and profits ultimately, of course. That focus, I think, is the one which most investors are looking for in a team. That really driven, ruthless, relentless go-to-market mindset. And one of the problems we have, I think, and it's particularly true with people who are moving from a research or development background in universities or other big technology companies, is changing from the mindset of, well, I've got to make the product better. The market's demanding a better product, to I've got to sell the product. I've got to just take the product as it is and sell it. Now, that I might identify some fatal flaw, and I have to do something about that. But I think one of the issues that we often see in Cambridge, where we have highly scientifically educated founders, is that endlessly tinkering with the product and trying to make it better and deferring market engagement is a sort of habit. And this perennial focus on the technology rather than focusing on the fact that in the end, it's about the customer, what the customer wants, how the customer is going to respond to the proposition, and whether you can succeed in scaling the sales.
Yeah, makes sense. And I've also personally seen where I work as an tech solution provided to some of these startups, which isn't there. Yeah, I've often seen that sometimes the founders really get emotionally attached to their solution rather than focusing on the problem that they are trying to solve. So yeah, I
Absolutely.
totally relate
Absolutely. Yeah.
to what you
Yeah.
mentioned.
You've got to be prepared to ditch your baby and find another technique if necessary. Yeah, absolutely agree with you.
Yeah. And when I was there in UK, there were quite a few discussions on how the scaling of the business is comparatively easier in US compared to UK due to the money available there. But there was also a lot of talk about the collaboration and how uh, certain USPs that Cambridge, specifically in UK, uh, that the startup founders would have, so that the cross collaboration that UK USA can happen, and the startups themselves can scale in the UK itself rather than moving out and do the same in the US. So according to you, what are, and you have like extensive experience being into the UK uh, as an investor, seeing multiple startups scaling and probably getting failed and so on. So according to you, what are those USPs that you feel that any startup, so to say, gets when they are in UK specifically, which other countries may not provide necessarily?
Yes, I mean, I think the big learning, which I've had over these last 30 years, is that a technology company which is very strategic and delivering something really important in the marketplace needs to be as close to its customers as it could possibly get. Now, if those customers are globally distributed, then the UK is not a bad place to be, because we've got many global companies based in the UK. The oil majors, the great commodity companies, lots of professional financial services business are based in London because the time zone is very beneficial. You can both operate on Far East markets and in the US market in a single day. But on the other hand, if you're talking about applied technology, and you're selling to the major technology companies, particularly on the hardware side, then it's most likely that you're going to want to be in the US, because that's where your customers are. And you see that within the US itself. Businesses that are founded in, I don't know, Illinois or Toronto or wherever it might be, will end up tending to go either to Silicon Valley or to New York, depending on where their customers are. So I think that there has to be a rigorous focus on developing the business in the way that's in the best interests of the customers, not in the best interests of the economy from which that company came. And I think that lesson was taught to all of us, or has been taught to all of us over the last 25 years by the Israelis. Because, I mean, today Israel's got a major economy, a major regional economy, which is doing very, very well in Southeast Europe and across the Levant and into the Middle East. But actually, a significant proportion of Israeli technology companies, while they keep their R&D effort in Israel, move their headquarters to the US to be close to their customers. And I think the rest of us have got to apply that sort of rigorous methodology to where we locate the businesses, to make sure that we deploy that technology or that product in a way that has maximum customer engagement, maximum customer traction. So I think that's what the driver should be, rather than actually worrying about whether we're scaling up enough businesses in the UK or scaling up enough businesses in India or outside the US generally.
Mm-hmm. So the focus should be to be as close as possible to your target audience, target customers, and serving their needs.
It should be, yes, that's right. I mean, and when I say close, I don't necessarily mean geographically. You need to be optimally positioned and recruiting the optimal talent, because sales talent matters, business development talent matters, to service those customers. Now, frankly, if you're talking about selling to, Amazon or Apple or AT&T or Verizon, you need to be in the US, because that's where they are. And that's where they expect their business development relationships to be. That's where they would expect their strategic suppliers to be. So I think it makes sense, therefore, that when you deal with Verizon, which is what the Israelis would do, Verizon will think it's a US company that they're dealing with, that happens to have Israeli technology in its origin. And I think that, for a lot of UK businesses, we were better off if we follow that Israeli model. Now, there are other technology domains, pharmaceuticals, tech bio, where it's perfectly credible to be in the UK because, the big pharma are spread across the globe. There are many big pharma in Europe. There's quite a lot of big pharma in the UK and quite a lot of big pharma in the US. So there's absolutely nothing wrong with trying to service those by having your business development team in the UK or in continental Europe. But I think it's follow the customer, understand how's the best way to engage with the customer, which should drive where you scale up your business.
Mm-hmm. Makes sense. And how do you think that the Brexit has impacted the investment landscape, so to say, or what are the impacts or effects that it has made in the overall investment?
I don't think it's had a huge impact on the technology sector for a number of reasons. Obviously, that most technology marketplaces tend to be global. The biggest single market is the US. I don't think that the UK is at any particular disadvantage with the US. After all, the US and the EU still don't have a free trade agreement, and there's little prospect of either the EU or the UK getting a free trade agreement with the US anytime soon. I think Rishi Sunak's made it a high priority, as indeed has Joe Biden, to engage with India and to improve the trade flow and the talent flow between India and the UK. And I think all of those factors are more important to the UK technology economy than Brexit. I suppose if I was in East London in particular, because software development is such an important component of the fintech and digital ad tech and digital businesses based there, they'd probably be saying it's the restriction on visas for software and business development talent, which is the one bit of friction which Brexit has created. And I do think the UK has still not got its immigration strategy right in making sure it's got access to global talent.
Yeah, but I think recently they have, as you rightly mentioned, they have took Rishi Sunak and the government has took this in the priority to make it easier for the talent to go in and out and do such work in cross borders. So yeah.
I mean, yeah, that's right. The UK has definitely identified India as an important marketplace and an important place where talent, highly skilled talent, will come from, and therefore it's very, very important. People from the UK can work in India, and people from India can work in the UK, and I think the government is committed to that, which I applaud.
Right now, we see that this is an industry revolution 5.0, and there's a technologies like Web 3.0 and generative AI. So how does this impacts, or is it like a one item in the checklist of the investment? That because I've seen recently when I was in UK, I've seen that any startup that I was talking to, any startup founders that I was talking to, they had some sort of machine learning or AI component in their product. So and sometimes it seems like it is maybe due to brand and the optics that it gives from the investment perspective, and might not necessarily required for that product. But do you think that this generative AI and machine learning involvement into the technology makes it more interesting for the investor to invest in any product?
I think that you've got to view AI and machine learning from several different angles. I mean, the fundamental idea of machine learning, which is that a machine can iteratively improve its performance by on the basis basically of the failure or success of a given process, and then adjusting that process as it goes forward and learning from that, it seems to me to be complete common sense, since after all, nearly all digital businesses engage in optimization using A/B testing or whatever. That's just a human form of machine learning. So I think that, I would expect any business to have some capacity to use machine learning in its technology where that's appropriate. I think generative AI is a completely different proposition, because that's about making an existing knowledge base, which is, the whole of the internet and all that's available on the internet, much more accessible using plain language, and being able to have the knowledge base make inferences from its own knowledge of itself, which is what generative AI does. I think that's very, very interesting. I mean, and I've seen that many of the businesses that I've invested in are using it very intelligently. I mean, we've got a document processing business. It's a personal business investment of mine, and they generate all their form questionnaires from using generative AI. I mean, it's just a piece of productivity. It says, look, here are the questions I want to ask. Please, format them and put them into words. And they, it's cryptic when the person indicates what they want. Or we just need the standard, questions to identify somebody. It generates a form with all the things which are normally expected. So I think that every business has got to have the imagination to understand where they can apply AI to improve the effectiveness of their business model and to improve their productivity. And I think that that's the really big impact, is that it enables businesses to do more with less external resources. I mean, I went to South by Southwest this spring. I saw the CEO of Jasper AI speaking. They do basically advertising and marketing support. They've seen an exponential rate of growth in the last 18 months. Many major US corporations, B2C corporations, are using generative AI to help them write advertising copy, social media posts, all those things which did take an army of people are being replaced by machines. I'm not sure what that's telling us. It may be telling us that actually all that stuff was pretty much boilerplate copy anyway, and regurgitating it. A machine is much better at regurgitating it than employing a human being to do it. But anyway, nonetheless, it's clearly the way of the world. But we've seen these before, haven't we? We've seen, robotics in the past. We've seen, the adoption of mass production machinery and techniques in the past, all displacing human labor, all improving productivity. I don't think myself that generative AI is that different. And I just think its application is a matter of the imagination of entrepreneurs as to how to get the best out of it.
Makes sense. And yeah, I definitely agree. And there's a lot of debate going back and forth that it will impact a lot of jobs and people will lose the jobs. I feel that losing the job might not be the case, but the kind of jobs people are doing right now might get changed. Their role, responsibilities, and the work that they do, that might get changed. But what are your thoughts on the same?
Yes, I think I completely agree with you. I think that the only thing I think that the impact is that as time goes on, human jobs which are just about deploying labor or about repetitive tasks will become less and less available or necessary, because machines will do more and more of them. And where in the past that was about physical processes, the point is that mundane intellectual processes, we were talking about churning out pretty standard social media or ad copy, that's going to be done by machines. So what it is incumbent on, therefore, is for everybody to make sure that they are as well educated, as adaptive, as imaginative as possible in the workplace, because those are all qualities that AI and machines can't deploy, and which are uniquely human. And of course, there is that huge segment of human economic and social and intellectual and artistic and everything else activity, which is about humans talking to humans and engaging with humans and all the subtleties of that, which again, I appreciate that, in Japan, some people are using avatars in lieu of real friends. but in reality, of course, you can't substitute human interaction. And that's where people are at their best, is interacting with other human beings rather than digging holes in the road or churning out boring advertising copy, both of which are done much better done by machines.
Totally agree with that. My next question is very interesting, and there's a lot of debate going on. Is about cryptocurrencies. So there is a new form of currency, so to say, and people have invested humongous amount of money in NFTs, cryptocurrencies, metaverse, so to say. What do you think? It is like it's there, it worth investment in such cryptocurrencies or NFTs or whatever it is, or do you think it's just an hype, or it should be first regulated, then it should be taken into the practice, or do you think that this is the future of the currencies? Or
again, what a wonderfully interesting question. And I'm intellectually very much in favor of robust cryptocurrencies, and therefore, I think Bitcoin is on the way to becoming, a stable long-term, store of value. Many people have tried to cheat it or crack it or bypass its security or the distributed ledger, the blockchain technology, and haven't succeeded. So I've got a tremendous interest in it. I think there are some limitations, though. The computation required to mine coins is very, very worrying. And the slowness of writing to and retrieving from the ledger, as the ledger gets bigger and more complicated, and you rely on its distributed nature, slows down the transactions, and that makes it not as flexible as it needs to be. So there are a number of challenges which both cryptocurrencies and all blockchain-based solutions need to overcome. The most important of which is the speed of being able to update the ledger and record and deal with transactions. But I think that rationally, there's no reason why Bitcoin, if you can overcome these problems, shouldn't supplant gold as the fundamental store, a store of value or abstract store of value. You may not agree with me, but I do think gold actually is essentially a form of abstraction, in the sense it's got recognized universal value, which is not really to do with its practical application. So I do think it's a really interesting area, and I would like to see, if we can overcome these limitations with cryptocurrencies, I'd like to see them having a bigger part in the global economy. And I'm not particularly in favor of regulation. I think there is regulation of financial services is important. So if you're building a financial services business which is exploiting crypto, then your business should be as regulated as any other. But of itself, I don't see why crypto should be regulated, and I'm suspicious of the idea that governments are trying to control it so that they can more easily manage their own fiat currencies. So that, I think there is an interesting tension there which we need to overcome. And then on the other hand, the general use of blockchain, I think, is really attractive, because it's a wonderful way in making sure that any digital asset can be validated, its provenance identified, its true ownership understood, the rights that accrue to it and which people can use it for can be transparently demonstrated and audited and potentially policed. So I think it's really, really important technology, and it's the way in which the Wild West of endless copycatting, unlawful copying of digital assets can be controlled and restricted, is by having a robust blockchain infrastructure running underneath, in the way, of course, NFTs are designed to do. So yes, I'm very positive about the potential, but I do see that there are some significant limitations at the moment. And of course, last but not least, there was a period in which it became, a speculative asset class, and it's always a bad thing when an asset's value is driven by speculation rather than by fundamental value or fundamental market value.
True. And the really interesting point that you lastly made, the speculation of the asset value. And I see that people take Bitcoin more as an asset rather than currency, because it works as a commodity in a way that it has a limited number of Bitcoins available, and people will keep, buy it or keep it and wait for the value to go up and so on. And let's in terms of its usage and currency, I think people and even governments, like for example, Indian governments have announced that they'll be launching their own cryptocurrency, which will be used as an actual currency in the overall India.
Well, I think I think there is a big difference, because I don't think fiat currencies turned into crypto, embodied in crypto, is really a cryptocurrency. A cryptocurrency has to be independent in the way that Bitcoin is. Otherwise, I don't think it's really a cryptocurrency at all. But I can see why governments would like to use that approach, because it enables them to digitize their economies. After all, the Indian government removed a whole load of banknotes from the economy to try and slow down the black economy, improve the tax take, all the other things which I'm not criticizing them for. I can understand why governments would want to do that in the public interest. But I don't think that that's the nature of what a cryptocurrency is about. It's really about digitizing a fiat currency. And the one thing I would say, by the way, just going back to speculation, I'm very conscious of the fact that everything is a compromise, and you do need speculation, because arbitrage gives liquidity, and any market needs liquidity. You need somebody who's going to make a price for you. If you don't have a market with people who are prepared to make a market, then you might as well not have a market. The market won't function. Without functioning, then it ceases to be a market. So you can have the perfect, efficient marketplace where everybody's a very, very sort of narrow arbitrager, and they know what's in circulation, and they can see who's buying and who's selling, and they adjust the price slightly. But actually, you also need a whole load of, from time to time, you need a whole load of suckers to go into the market and buy the stuff, and increase the liquidity. I'm afraid, that you can't have the one without the other. So I'm probably being a bit pious when I say, oh, it's terrible, the speculation. Maybe that's a necessary part of a marketplace, and that's what makes it potentially very, very potentially successful.
Yeah, or maybe simple tweets from Elon Musk that I'm interested in this, and it will increase the price of any cryptocurrency, so to say.
Was that was that cryptocurrency manipulation or not? God knows. Almost certainly it was. Whether it was intentional and cynical, I don't know. I can't get inside Elon Musk's mind.
All right. Last few things that I would love to know from you is that how the investment strategies have changed over the time in the funds like yours. What are the parameters that previously the fund used to consider, how they used to collect the data, and now, given that there is a lot of technology coming in, what approach does the investment firms follows?
Yes, I think that's an interesting question. I don't think that fundamentally the intellectual approach is any different now than it was in the 1980s. But I do think things have changed. One of the things was the revolution in software development, which happened from the mid-90s and onwards. People often talk about LAMP. Do you remember Linux, Apache, MySQL, and PHP as suddenly enabling people to put together web solutions very, very quickly, in weeks. And if you look at the example of Y Combinator, I can't remember what year Y Combinator started, but it was 2002 or 2003, somewhere around there. And of course, they were exploiting LAMP and that whole approach to enable small teams of very focused young engineers to create actual businesses within the time of the program. that was unknown. I mean, when Sunil and Prashant started their original digital business, Go Surprise, it took a major engineering effort over a year even to get the first edition of the product out. Because it was very complicated to deploy an e-commerce solution in the 1990s and early 2000s. But now it can be done very, very quickly. And I think that has changed the mindset of venture, in that everybody is about trying to find a way to get in and get out within 5 or 6 years. But actually, an awful lot of deep tech, like we're investing in Cambridge, especially on life sciences, but also on physical sciences, takes much longer to come to market, to cook, and to realize. And it's very unpredictable when the value point will come. And our most successful deals have taken 15 years from first investment to substantial value point, either IPO or trade sale. And that's much longer than the life of most limited partnership venture funds. Now, lots of fund managers have succeeded in investing and achieving returns within 5 years or 6 years. And of course, the later you're investing, the easier it is to do that. But I do think, therefore, the one tension, the one issue, the one thing that we've all got to think about is, how do you optimize value in a venture portfolio? Is it about getting out at whatever cost within a predictable timescale, 5 or 6 years, or is it about letting the businesses bake to the point of optimum value, which may be 15 or 20 years out? And can you find limited partners to come into your fund, or whoever, who are prepared to wait that long? And then that brings you back to a whole load of other interesting questions about liquidity, which is the fund responsible for providing liquidity through the stream of realizations, or could the fund's ownership be traded on a market like an investment trust? So I think there are some interesting questions going forward about the nature of venture capital funds, about where the money's going to come from. I mean, the UK government, of course, is trying to push pension funds to invest more into venture and private equity, because, of course, they tend to be long horizon investors who don't necessarily need to liquidate liabilities until much in the future, when the pensioners come to take their pension. But equally, they do need liquidity in the short term to pay their existing pensions. So that if we can get that matching done more effectively, maybe the UK government's present initiative to try and increase pension fund involvement in venture investing might be successful. But I do think that's one of the big issues that we face in raising money for venture, is the liquidity issue, knowing when we can get out, and the fact that actually most other investment asset classes, there's a much higher degree of liquidity and predictability of when realizations might happen.
Makes sense. And lastly, what are your advice for these early stage founders, early stage entrepreneurs, those who are looking for investment to have a basic setup for their company, or to scale their company? What are the things that they should consider while they approach any investors to raise the fund?
I do think the one thing that I see very underdeveloped in most early stage business plans is an understanding of the go-to-market strategy, or really understanding not just who the customer will be, but why the customer will buy, at what price they'll buy, how you reach the customer, whether there are perverse incentives operating in the marketplace. So it's instead of being quite so technology and product focused, I'd really like to see entrepreneurs being much more customer and market focused. It's only that way that you build a business which will successfully grow and generate revenue for the future. It's the key to everything. It's to have this relentless customer focus. And I mean, I think if you look at the people who we all held up as examples of building great businesses, Steve Jobs and Elon Musk, then it's that focus on delivering what the customer really wants, really taking the time to understand, double down on the fact that in the end, the product and the technology, they're just, they're just tools in delivering a solution which that customer really wants and will pay for in the long term. And that's the thing which I think most founders find hardest to do and neglect most, or do least rather, is having a really good go-to-market strategy as part of their initiative. So that's what I'd say. Any early stage founder is concentrating on go-to-market, and also, with scaling the business as well. It's all about how do you grow that market. It's absolutely about the relentless focus on the customer.
All right. Lastly, I think there's a lot to learn from you, and I think it will take a couple of more podcasts to have conversation with you to learn from different perspective on different experience that you had. But I think in the interest of time, uh, would like to know from you any closing comments from your end, anything that you would like to pass on or mention to our audience.
Yes, I mean, one thing I do feel is really important, and again, I said it to you right at the beginning, was about the cycle. Don't be discouraged just because it's difficult to raise money today. If you've got a good idea, you've got a good product, you will raise the money. You just need to be persistent. And it's a good time to build a business, because if you can succeed now, when the good times come, it's going to be much, much easier to grow the business when the capital becomes freer and more available. So that scale-up phase will become easier because of the pain that you've gone through in the startup phase. So be optimistic. It'll get better. It always does.
Awesome. Thank you so much, Martin, for taking out time and joining us this podcast. I thoroughly enjoyed it and got a lot of learning and insights from you. I'm sure our audience and listeners will have the same. So thank you so much for your time, and I really enjoyed the podcast.
Actually, thank you very much for asking some really interesting and challenging questions, which I very much enjoyed answering. Thank you. Bye-bye.
Thank you. Bye.
Bye-bye.